Hello and welcome everyone. Welcome back to my channel. Today we have a special guest and she is so cool as well as being special, but her name is Gladys Isabel Ricarte. She's actually born in Colombia, but now she's here working as an insurance and financial services specialist. And she actually helps, that's a big lingo for just helps with your financial planning. She's really good at it. So Gladys, give you the floor here.
Hello. Hello, it's a pleasure to be with you here, Javi. Yes, as you mentioned, I work for a company and we help people plan for their financial futures, basically just taking their goals and making them into a reality by bridging the gaps with our products and services. So grateful to be here, Javi.
Something that really stuck out for me that a lot of people would be interested in, especially since they just bought a home or maybe they have a home, is called, I think you said mortgage protection. Is that right?
Yeah, so we have this really fancy word or concept called mortgage protection. But essentially what it is protecting a piece of an asset that you have with a type of insurance, but that's typically a life insurance. Something that lots of people don't know is that there are many types of different life insurances, and they don't necessarily all do the same thing. I think we're all familiar with like the 20-year term, you have a locked in like rate for 20 years and then it shoots up after a certain amount of years. And I guess a lot of people are not necessarily educated. There's different types of insurances that do different types of things, and not all of them are the same. And they're not necessarily just a bucket that you're losing money in to maybe perhaps if you die one day. There are insurances that have living benefits, and some of those living benefits could be mortgage protection. So there are some that could accumulate cash value as well. So you don't just have the death benefit, you also have a growing piece of cash that you can use in the future, perhaps as like loan. And so all of these features are really unique to which insurance provider is working with you. So I would say I would always encourage people when they're sitting down with an insurance or financial professional to always ask about the different types of products they offer, because there are really a myriad of products and they do different things. And mortgage protection is really just one of the ways you can use a life insurance policy in a more dynamic way rather than just maybe paying into a policy for a set amount of years and then maybe not using it or dying and that being the only use of it. So I do want people to know there are things like living benefits attached to different types of policies. So it's definitely something to be aware of.
Sure. And this is really exciting for me to hear because before chatting with you, I actually didn't know that this existed. I thought it was not living benefits as well. But can you tell me a little bit more of the benefits that people could use from, let's say, mortgage protection, just since we're real estate related here, or other things as well for people to benefit from?
Yeah, so essentially you could really take the living benefits and apply it to any scenario. But if we're going to apply it to like a home, let's say you buy a policy on a home, you could buy the whole, like let's say your home is worth 250. You could get a full 250 policy to cover it for that like 20, 30 years.
Hmm.
But you can also have that policy have like additional benefits to it. It can be amended, and it could have the living benefits portion of it. And how it works with my company particularly is that there's dividends paid back into the policy. So you're accumulating what you pay into the premium, additionally with what the company is giving you back every year with dividends. So you're getting an accelerated rate every year. It really hits a really like high point between the 10, 15, 20-year mark where the dividends just accumulate on top of each other and the policy grows and it balloons and you have suddenly like, this reserve of cash that's tax free and you can loan out with any time and you don't necessarily need to pay, you don't have to pay any taxes and you don't have to pay any surrender charges. It's like completely your money. So it's a big like tax free bucket of income you can use to accelerate paying off your mortgage in the future. So for
Tax
example,
free.
yeah, exactly. Big
That's
one.
unreal.
I think that's something that a lot of people are really like interested in like learning about is really diversifying their taxes. And that's something that at my company we do really well at. Work with business owners and individuals. But something that we really have to get the public educated is really the three buckets of assets. You have your ordinary income, which is taxed before, then you
Hmm.
have tax deferred income, which is all 401ks, IRAs, annuities, other deferred compensation programs. And then you have finally the tax-free bucket. And those are Roth IRA accounts, 529 plans, municipal bonds, and life insurance. So if we're really thinking about how to diversify how much we're paying on taxes, we really want to increase the tax-free bucket a lot because it's going to allow us to put in more money or put a lot of more energy in the tax deferred and ordinary income buckets, which are typically what we focus on. It's our jobs, it's what our
Mhm.
labor, it's our ordinary income. So how do we grow this reserve over here so that we maybe have more freedom in the avenue over here to take more risks? And as you probably know, more risk, more reward. So
More risk, more reward. But
yeah.
I would say that with a financial advisor, a professional as yourself, I guess the risk is more guaranteed versus taking risk in, like, let's say I'm going to the slot machines or I'm going into the stock market with no practice. You're more of a calculated risk, am I right?
Absolutely. You have basically a bucket of money that you can really project to see in the future. And you know it's going to be in a safe asset because it's not in the market, it's in life insurance.
That's
So,
awesome. That's
mhm.
awesome. That's
So
really
it
cool.
really does make a difference in terms of getting people set up for a more stable future. Because it's like if you know you're saving or you're putting money away in, let's say, an IRA or a 401(k), which is great, it's wonderful, you're going to have to pay money, taxes, and sometimes charges if you take the money out too early. If you take it out
Hmm.
before the age of 59 and a half, you're going to have to pay extra money. And it all adds up. And sometimes what you're seeing reflected on the IRA and 401(k) balances isn't what you're going to get at retirement. And a lot of people don't understand that. And that's the importance of really increasing the tax-free bucket because you're going to need to supplement after you have to pay taxes on all of the stuff.
That is true. I mean, I've heard things, I don't know if you know anything of it. Um, I've heard things here and there in the woodworks, like you can change your taxed one into the untaxed IRA, something like that. But I don't know if there's a limit or what the qualifications are.
Yeah, it's definitely there's a lot of rules around it. It's not for all. A lot of the what makes navigating these types of accounts and like really like the reduction of taxes really difficult is it's a case by case situation. So everyone's situation is going to look different, which is why we typically encourage people to sit down with someone and really do a full review of where you are now and where you want to be. Because sometimes our goals don't necessarily align with our actions. And so perhaps we might have the best intentions. We might want to, perhaps move a vehicle of money into a more like free vehicle, but it's like, do you qualify for that vehicle? Not everyone qualifies for a Roth. You
Mm,
have to make under 146,000, I think, is right now the limit. Uh, to be able to qualify for a Roth. So not everyone's going to qualify for a Roth, but there are other alternatives like backdoor Roths and other things. So it's like it's really case by case situation. But so far as we know, the rules right now are if you have 401(k) IRA, those are all tax deferred and you're going to pay taxes on that and they're not necessarily liked. And I think one thing that we have to keep in mind too is with all like the national deficit ballooning, I
mhm.
think we can expect to pay more taxes, everyone in the future.
Okay. Well, that's exciting. That's that's
I
exciting.
think that was probably not the best way to say it, but if you do look at the history, if you do look at the history from the 1930s and now, it's just been an increase.
Yeah. I mean,
So,
that's everything.
yeah.
It's actually really funny that you say that. I was looking at a graph the other day about how real estate prices have increased, right? But
Hmm.
when you look at the needle for wage increases, it has been
Yeah.
it doesn't compare. It's
Hmm.
not parallel by any means.
Yep.
So that's why it's so important to really like create your wealth in not only just real estate, but like having financial advisor as yourself that can help you create more wealth for yourself so that you're well off. Because I can't tell you how many people, are well into their 60s, 70s, 80s working not because they want to, but because they have to. They haven't been able to retire, and it's sad because like no one should have to do that when you're well into that age. I mean, you should do it even earlier. I want to retire at like 45, 50 years old, just be relaxed.
Yeah.
But I'm confident that talking with a financial advisor as yourself, that will be a more plausible, realistic goal to have and achieve.
Yeah, honestly, the difference between like being able to retire and retire well and early perhaps is and not being able to at all is really just planning.
Mhm.
Which sounds like really like almost like a privileged position to say that, but a lot of my clients who I worked with and early on, a lot of them didn't necessarily have lots of assets. So I was really working with limited budgets and positions, but because we were able to put in certain types of protections and really tax diversify their income and really just put in like a bucket of like secure money that was going to grow for them, they had way more like freedom to go and perhaps pursue things that they weren't able to do before or take more risks and really have more ownership over their financial decisions and their assets. Because a lot of times, like you had mentioned, we give up things that are really, really important to us, not just our working years, but also like our houses. Sometimes we have to sell off our assets because we just fully cannot like sustain ourselves. We didn't expect all these fees. We didn't expect all these charges. We really didn't read the fine print. And so it's like, how do we create a separation or more financial freedom for us in a really safe way? And that's when planning comes into it because you have someone who's looking at your situation with a holistic lens, a comprehensive lens, and they're not giving you a one size fits all solution. And I think it's great when you have a lot of like people who go on generalized podcasts and they give generalized advice, but
Mm-hmm.
really like it's really you should really, really focus on someone who's going to look at your situation holistically because in that moment perhaps your goals might shift in the future.
Yeah.
It's
Yeah.
not it's not a one size fits all. It's also not a one-time job. You have to, you really have to be committed to your clients and following up with them every year, every 6 months, making sure that the plan is still current to date. Maybe they had kids. All of that adds to like life events. All of those add
Mm-hmm.
to financial events.
Yeah.
So we have to really keep in mind that we have to look at things comprehensively and on a case by case basis. And also, we have different goals. Like everyone has different goals. Not everyone wants to be a millionaire. Not everyone needs a big bucket of money at the end of the day. Some people honestly just want to live comfortably, and that is perfectly fine because sometimes it's just a better solution for them. So it's like you can't really give a one size recommendation. It's like, oh, you know, I always caution people against that. It's like I share the knowledge that you know, but also just know that everyone's situation looks different.
Yeah. I, I couldn't say it any better. I mean, I wanted to jump into the next topic because it would have bridged really nicely. Everyone said like I didn't want to get you off your role there. Like it's really good.
Thank
But
you.
with that being said, I did want to jump to a topic because you touched on something that is really important that a lot of people experience. A lot of my clients have to forcibly sell their homes because they can't keep up with the payments because somebody passed away, whatever it is. And I know we talked a little bit about options about disability. Could you tell me more about that?
Yeah, of course. So I think a lot of people are like familiar with, the government giving disability benefits, but also something that they probably don't necessarily know is that you can get your own disability benefits through a private company.
Mhm.
And it's typically you're going to get more than what the government would give you. The process is much faster. It's more streamlined. It typically is just a phone call to your financial representative saying, "Hey, I like lost my job." And if you have disability income protection, you're essentially locking in what you're making in your working years, and you can basically get a payment. Let's if you go through an event that disables you, which I think about 25% of Americans in their lifetime become disabled. If you go through a disabling event and you have disability income protection, you immediately just have you call your company, and since it's private, it's streamlined. You have your contract already ready, and you have how much you were making, and you
Mhm.
receive a percentage of how much you were making already. And so it's much easier and faster than having to wait for the government benefits, which in many situations sometimes don't pay out for X and X reasons. So I definitely know a lot of clients who, for one reason or another, just couldn't get like benefits, and then they didn't have any income for months or years at that. And all of that is playing a factor into maybe I'm going to have to lose my home, or maybe I'm going to have to move some things around. I'm going to have to take a course of action that was anticipated and unanticipated, and it's kind of like shooting myself in the foot. So how do I prepare for that? There's private disability income protection that honestly, the younger you are, the better off you are, because you can lock in how much you're making in now. But if you anticipate to make more in the future, let's say you get it when you're 20 or 25, but you know you're going to make more in your 30s or 40s, you can anticipate that growth in income based on your career. All of that's factored in. It's really like a detailed and case by case situation. So it's like if you know you anticipate to grow in your career or you have an idea of where it's going, you can protect your income. It's also available for people who are self-employed as well. So it's a way to like sort of really hedge against, the fact that they're running their own business, they're taking this risk and they're not working under like a company that's a 401(k) or something. So it's really, really covering a lot of the bases. It's privatized protection, which I think in a lot of ways gives a lot of people freedom.
Okay. Excuse me. Well, that's a lot of information right there. So if I'm going to give you a specific scenario, and I guess that you can give me your feedback on it and how we can prevent it, because this happens to me that I deal with clients all the time. Um, let's say that a significant other passes away and you have versus not have those protections. What do you see as being the course of action, or what do you see usually happening in these situations when you own a home?
Well, typically, let's see, if let's say that the working spouse passes away, and then
Okay.
you have a non-working spouse, perhaps, or perhaps a spouse that makes significantly less than the first party.
Okay.
Um, that is a very typical situation in this country. And so if that
Okay.
happens, the non-working spouse or the spouse that was making significantly less is now suddenly burdened with like all of these expenses that they weren't able to like they weren't before paying for. And so it was really unanticipated. Typically, I think there is a big gap between like widowed women who like probably the boomer generation now, who really, if their spouse passes away before them, they're left in a financially vulnerable position.
They
Um,
are.
you
Yes.
don't we don't have to like spit out statistics, but you can look it up on your own. But most people, they probably lose a lot of their net worth already in the next following years because they just weren't in charge of the financial management of the household, or they just
Mhm.
didn't have enough capital themselves to really maintain the lifestyle that was being had. Um, and so one way you can really hedge against that is adding riders to different types of insurances. Obviously, life insurance is great because it's going to pay out if the primary spouse dies, but you can also add a rider that keeps the whole plan in place for the other spouse as well. So let's say you have an insurance policy with living benefits and the first spouse passes away. You don't necessarily lose all those benefits. You do get paid the death benefit, but then the policy just transfers over to the other spouse. And if there's cash value already accumulated, they have that and they can use that. And
So
they
it's
can have,
transferable.
yeah, exactly. You can add rider, surviving spouse riders. So basically you can protect your spouse. If in the case if you die, you don't just necessarily give them a death benefit, but you could also just transfer the entire policy and then they could use that money for whatever they need to. Um, there's another one that's like really popular is this concept for supplemental retirement income. So really using again the living benefits to like hedge against for the future. So if you think you
Mhm.
don't saving enough money in your 401(k) or in your IRA right now for the future, and you know you're gonna have to pay all these fees, and a really good way to like diversify your portfolio is to get into insurance and then really live off the living benefits because you can really customize it to how much money you're going to need in the future. So that's all something you can do.
So since we have all this transferring going on and the topics of transferring, I know we talked about briefly child gifting. What is child gifting?
Yeah, so again, a lot of these concepts are really related to each other.
Hmm.
Child gifting is essentially when you buy a life insurance policy for a child, which sounds crazy because you're
It
like, it's a
does
child.
sound crazy.
Like,
I'm
why,
telling you,
why,
it
why would
does.
you get it for a kid? They're super young, they're super healthy, and that's exactly the reason you should get it for them. Because if you get it for them earlier, the interest on the dividends accumulates much, much faster. And by the time they get to like, let's say 2021, they want to go pay off college, get a big bucket of money you can use. Same thing for weddings, big life like expenses or events that you anticipate to have in your life.
Mhm.
Um, Typically it's done by like either parents or grandparents that really just want to help the kid out. And like at a certain age, the kid will be 18, they'll have access to that money. I usually advise parents to not necessarily share that information when they're 18, just because I feel like an 18-year-old wouldn't make the best decisions with a bucket a load of money. And so I typically say like to my clients, hey, like if you feel like that's not the right age to, give them all this money, I would say don't tell them about it because you are the owner of the policy. Wait until they're a little bit older, 20, 24. and then you can like maybe share with them what they have. But by then it would have accumulated much more, and then they could use that money for whatever they want to use it for. Like it either be paying off school, starting a business, like all of these big life events that are really come up. And it's nice to have something to rely on, but it's also nice that this is something that the everyday person can do. For like it's not something just for like people that are uber wealthy. Like
So
no,
this is an exclusive for the wealthy.
no, it's actually, well, this type of life insurance like dynamic implementation has really been what has like really grew the middle class in America for like the past 100 years. So
Okay.
like, if you were able to transfer wealth from generation to generation, that wasn't something that was exclusively for wealthy people, but it was accessible for people who had life insurance. And now that we know that we have different types of life insurance that can also give us living benefits, now we know that the transfer of wealth can also be within our own generation as well. So we have more flexibility on really what we're able to do with these vehicles. The lots is changing, and every time I feel like there's a new product or something new that we can do and something we can offer. So I definitely would encourage people just to really explore these options, because there's more out there that is available to you than you really know. Like,
Okay. So long story short, because there's a lot of information we went through here, people
yeah.
that are watching this right now are like, what did I just hear? Like they heard one thing that interests them, but then it went out into an abundance of knowledge that they don't even like myself. I'm in real estate and I'm learning these things, and I'm still blown away by everything you're talking about. And I have to like figure out how I can understand everything and condense it. But in the chance that they did want to reach out to you, you do offer these services not only in English but in Spanish. Is that correct?
Yes. I also have a group that works in Portuguese as well. So we can
Ah, so
we
three
can accommodate
languages.
we can accommodate for sure.
Okay. So if you had a couple things to say to people, if this is the end of the call and you wanted to leave people with these tips or things that they should be doing, what would you want to say to everybody out there?
Or to break it down, I would say that there are definitely a variety of vehicles out there that you can use to really expand your financial position and really get to a place of financial freedom. And it's
Mhm.
something that everyday person can do. It just requires planning and adjustments and someone who's willing to back you up on your objectives. So I would say work with a financial professional who understands your situation and who is sympathetic to your situation, not just a person that's gonna be meet with you once and then never meet with you again.
Yeah,
I feel like that happens a lot in this
it
industry, and perhaps
does.
it's maybe just the nature of it. But for me and my own personal goal and purpose in life, is to service other people to help them become the greatest version of themselves. And for me, that requires a lot of commitment. And I feel like if you're going to work with someone who you're going to share these intimate details with about your life and who's really, looking at this really carefully, they're going to be someone you're going to want to have a relationship with for the rest of your life. It shouldn't be someone that is going to just sell you something and walk away. If someone does that, that's probably not a good idea. Like it's probably just not going to work out. You're probably going to be really upset in 20 years because
Yeah,
something didn't work out. And one thing I would say is it's all based on trust. So it's like you want to find someone you can trust and someone who's going to follow up with you and someone who's going to be there for you. So that's one thing I would say, but also I would just run it back to the four basic concepts of mortgage protection, disability protection, child gifting, and all wrapped up in that is beautifully tax diversification, because you can tax diversify with all those three concepts. So if any of that interests you, if you're interested in protecting your income, protecting your mortgage, or perhaps giving your child a future where they are able to use amount of money that perhaps they wouldn't have access to
mhm.
before. These are all things that the everyday person can do. Um, I started working with really, really like low income communities because I really wanted to make an impact and just really help create more wealth in my own personal community.
Mhm.
But just know it's something that everyone can do. It really just takes planning and someone who's willing to understand your situation and someone that you trust.
That's well said. And for all the people that are viewing, the first day I met Gladys, she said the exact same things. I am passionate about helping my community. And that is so true, guys. So if you do feel like you want to have someone that you can trust in your corner, helping you with your finances, understanding these things, and preparing you for the future and future success and wealth, I have no doubt that Gladys is a person you guys would at least have to have a conversation with. And Gladys, thank you so much for coming on here. We really appreciate it. Everybody that's watching is going to love this video. And if you guys want to reach out to her, I'm going to have some information linked below. But regardless, I'll see you guys later.